Hello everyone, welcome to my session. So guys, in this session I'll discuss cost of capital chapter for CA inter students. So guys, welcome to my session. My name is Amit Kumar Singh. I'm a SEBI registered research analyst and investment advisor. So in this class we'll discuss the basic concepts related to this very important chapter called cost of capital. So before I start talking and discussing the numericals regard to cost of capital. First of all, we need to understand what is capital. So capital is the fund what we are looking to start any venture or to work on any venture. The fund what we are looking for is called capital. So this capital we can raise by two ways. Either we can raise this capital by equity or we can raise this capital by debt. So whenever we talk about debt, debt is all about borrowing. Okay, so whenever we talk about borrowing, please remember that the in the case of debt, ownership is not transferred. So the very important part what you need to remember here is that in the case of debt, ownership is not transferred, but in the case of equity, you make others the part of your organization or the part of your ownership. So whenever we talk about debt, debt is always issued for a fixed duration of time. Debt is always issued for a fixed duration of a time. If a debt instrument is having a maturity less than 1 year, then we call them as a money market or short-term debt instruments. And generally, money market or short-term debt instrument don't gives you coupon, so they are also zero coupon instruments. While when you have a debt instrument beyond 1 year, then we'll call them as a long-term debt instruments. So probably when you study about debt instruments, you definitely will get into the words like bonds. Okay, you'll get into the words like debenture, convertible debentures, okay, non-convertible debentures. So the basic difference between bonds and debentures, although both are long-term debt instrument, it's is the nature how they are issued. Bonds are considered as a secured debt instruments. Bonds are considered as a secured debt instrument. Why they are considered secured debt instrument? Because uh, the organization or the institutions which issues bonds, their probability of default is considerably less. Okay, like Government of India. Okay, the probability of default is considerably negligible or less like Government of India. So the interest rate what they offer is called risk-free interest rate. Okay, this word is very important because in equity we'll do something called CAPM model and all. So that time this risk-free interest rate, this word probably is important and you have to remember this word. It's not like that the governments never default. In history, there are many instances when actually the government of the country, Russian government, has defaulted on ruble. So in past, default had happened, but it is being considered as a less risky than debenture. When we talk about debenture, they are considered to be unsecured debt instrument. Unsecured, again, the based on the nature how that debt instrument is being issued in the market. Okay, that's why they are called as unsecured debt instrument. Because maybe like recently Vedanta has issued NCD, non-convertible debentures, because they are raising money from the market. And if you are listening my videos around Feb of 2025, then you must be aware that Donald Trump is imposing a lot of tariff on metal and related sectors, because of which primarily during this time raising money by equity won't be very good option, because equity you give others the ownership, and maybe right now uh, public or institution may not be very much interested or optimistic to primarily invest in steel sector or metal sectors. So I'm just giving you an instances. So basically you have to understand that there's a term called credit risk. So whenever any institution borrow money, they borrow money with an obligation to pay back that money, and within the maturity of the instrument what they do, they give interest on that instrument, which we called as coupon. Okay, so coupon basically means the interest what they offers on their debt instrument on regular period of time, which we called as a coupon, and that would keep happening till the maturity of the instrument. Okay, so that way you can remember the debt instrument. Always remember that whenever we talk about debt instrument, ownership is never transferred. In the case of debt instrument, ownership is never transferred. Okay, ownership is never transferred in the case of debt instrument. But when we talk about equity, in equity, what do you mean by equity? Equity basically means where we dilute our ownership. It's what do you mean by equity? It is a mode of raising fund. It is mode of raising funds from the market. It is a mode of raising funds from the market. It is a mode of raising funds from the market where ownership is diluted, where ownership is diluted, where you raise money from the other institution, giving an opportunity for them to invest in your organization, or you are giving them an opportunity that they become the part and parcel of your organization. That way, when the fund is being raised, that is called as equity. Okay, the other way, when you borrow money, that you will pay back that money in the future with obligation of interest, then that way of raising fund is called as debt. Equity is the other form of raising fund from the market where ownership is diluted, where you are making other the part of your organization. Okay, so remember this part. And whenever any company raise money in the form of equity, basically they have two options. They can either go with internal equity whenever the company is raising money from the market. Whenever the company need to get money from the equity, they can use their internal equity, which is called reserve and surplus. So the first thing first, if you are looking for fund, so what you will do first, you will try to use your savings, right? Whatever funds you have, okay, you try to use that money first instead of going and taking money from the outside market. So if you are raising money, if you are trying to get the money from your internal sources, from the savings, what you have there in your balance sheet, then it is called an internal equity. While if you raise money from external market, then it is called as external equity. Okay, so if the company go for external equity, then primarily there are different ways are there. The company can do private placement. Okay, the company can do a private placement, or what they can do a public issue. They can do a private placement, or they can do a public issue, or what they can do, they can go for a preferential allotment, or they can go for a preferential allotment. Okay, so preferential allotment is what is public issue, what is private placement. So imagine if a private company raise money privately from the market, then it is called as private placement, where the ownership pattern of the company does not change. A private company would still would be a private company. Okay, then that way if they're raising money from the market, then it is called as private placement. Okay, while if a public company, instead of going public to get the money from the market, maybe the current scenario when the stock market is not doing very well and all, so primarily raising fund from public would be difficult and challenging job. Company like Hexaware Technology, they are coming with an IPO right now. From 12th February to 14th February was the IPO, and their GMP was hardly 4 to 5%. Means nobody is right now interested to put money in Hexaware, although Hexaware Technology is very good company. I'm just giving an example that it doesn't matter you are how good with your business or how much potential you have with respect to the business. What matters is that the way the stock market is behaving at that moment. If the stock market is good, then primarily any company, if they don't have good financials also, if they're coming with an IPO, that will go very easily with the market. But when the market is not behaving very well, then that time raising fund from the market would be very difficult and challenging job. So that time, if a public company, instead of going for public issue, if they do a private issue to get the fund, maybe from money lender or some private equity companies are there, from them if they are raising funds, okay, okay, or through venture capitalist, or maybe some banks, if, or there are lot of firms are there like Hilton Group, Carlyle Group, Blackstone. Okay, from them, if you are raising fund, okay, that way, if you are getting the money from the market, okay, instead of going and raising money from the public, that way is called preferential allotment. While if a private company would still act like a private and they get money from same way, like either from venture capitalist or from private equity funds, where the ownership pattern don't change. Okay, then that is called private placement, while a company can do a public issue. Public issue means first time when they do the public issue, it is called as IPO. IPO stands for initial public offering. IPO stands for initial public offering. First time what you are offering to a public, it is called as IPO, initial public offering. So if a private company want to raise money from the public, and if they target 50 people or more than 50 people for getting the fund from the market, then it is first time if they are doing this, this is called IPO, initial public offering. Once the company IPO is done, then again, if they are looking to raise the fund from the market, they can raise the fund from right issue, or they can do right issue, or they can do FPO. FPO stands for follow on public offering. A right issue basically means through a right issue you target your existing shareholder to raise fund from them. That is called right issue. While if you target anyone and everyone, either the existing or new shareholder, if they are ready to put money in your ownership, where they can get more part of your ownership and they can get the fund what you are looking from them, then it is called as FPO. FPO stands for follow on public offering. So there are different ways are there. A company can raise the money either by equity or by debt. So if the company is raising money by equity, then primarily what they are doing, they are giving their ownership, the part of the ownership which we called as share. So what is share? Share is the part of ownership. Share is the part of ownership which any company, which any company, which any company dilute at the time of public issue. Okay, public issue basically means 50 people or more than 50 people. If you're raising more than 10 crore rupees from the market, then it is called as share. Then it is called as a public issue. So share basically means the part of ownership per unit part of, not the part of ownership. It is per unit part of ownership which the company dilute at the time of public issue. And through this, they raise money from the market. Share can be ordinary share or a share can be preference share. So whenever we talk about share, a share can be an ordinary share or it can be preference share. When we say ordinary share, when we say preference share basically a redeemable equity instrument. When we say preference share, they're basically a redeemable equity instrument which the company will buy back in the future. Okay, so preference share, if you are having preference share of the company, you are not the actual owner of the company, and the company has taken money from you for a fixed duration, and whenever they'll pay dividend, they'll give you first preference. Okay, but you don't get the voting right. You are not the owner of the company. Okay, if the company get bankrupt or if the company get diluted in the market, you will be given first preference over the ordinary shareholder while the time of liquidation. But preference shares are redeemable in nature. Redeemable means they will sometime in the future, their value will cease to zero and company will give back your money, whatever the money they have promised you. That is called face value. Ordinary share, when we talk about ordinary shares are irredeemable equity instrument. Ordinary shares are irredeemable equity instrument, irredeemable equity instrument basically means that the company will never uh, take your money back. Whatever money they have given you, they till the time if the company don't get bankrupt, they will not take that money back from you. Sometime some company do reverse book building. The reverse book building is the reverse of IPO. Reverse IPO, that is called reverse book building. If that happens, then they will buy back the share from you, but don't at the face value. They'll buy back at the current price at which the share is trading in the market, little bit higher than the current price. They'll buy back that share from you. Okay, so it won't happen in the face value. But if the company, if they get bankrupt, then what value you get from that issue, that is called as the face value. Face value is an irrelevant word as such in the equity instrument. Like I'll give you an example. Like Infosys is right now trading around 1800, 1900 rupees. If you see the face value of Infosys, it is 5 rupees. That means that by any chance, if the Infosys don't exist in future, although Infosys trading around 1853 rupees, the face value of Infosys share is only 5 rupees. Means that if anything, if the Infosys had to get bankrupt, okay, then what the value what they'll give back to the shareholder per share, that would be only 5 rupees per share. That basically means by face value. So face value as such, face value is not a relevant word when we talk about equity instrument. I hope this part is clear with all of you. So here, when we are trying to understand the capital part, so the capital you can either raise by equity or you can raise the capital by debt. Okay, so whenever we are talking about capital, you can raise the capital by equity or you can raise the capital by debt. So cost of capital is basically the return expected by the provider of the capital. Okay, the who is providing you capital, either they are equity holder or either they are debt holder, the lender or debt holder or shareholder. Shareholder are those people who will give you capital in the form of equity. A lender and debt holder are those people who will give you capital in the form of debt. Why they'll give you capital? Because you are looking for fund. Okay, liquidity and fund requirement is a basic part, a basic nature of how we work on a business. Okay, so as such, why they give you capital? Because we all contribute to the overall capital. So the contrib for giving, for having a contribution to the overall capital, people will give you capital either in the form of equity or either they will give you capital in the form of debt. Okay, so cost of capital is also called as cut-off rate or hurdle rate or minimum rate of return. You can remember this. So whenever we talk about cost of capital, the other name of cost of capital is cut-off rate or hurdle rate or minimum rate of return. Understand that what happens that you are raising fund, either you raise fund by equity or you raise fund by debt. So always the cost is involved, right? So the cost what is involved in raising fund by equity, then it is called as cost of equity. So the cost what is involved in raising fund by equity is called as cost of equity, and the cost what is involved in raising fund by debt is called cost of debt. And the sum total of this cost is called WACC. WACC means cost of some WACC means weightage average cost of capital. So this is basically cost of equity plus cost of debt into 1 minus tax. Because why 1 minus tax? Because in the case of debt, you will get the tax shielding advantage. You don't get any tax advantage in the case of equity. Okay, so WACC basically means weightage average cost of capital, weightage average cost of capital. Okay, so it is basically whenever we are raising capital from the market, it's not like we are raising capital in equal proportion of equity and debt. We'll raise capital in some proportion of equity and debt. So the cost, what is involved in raising capital by equity is called cost of equity, while the cost what is involved in raising fund from debt is called cost of debt. And whenever we are talking about cost of debt, generally to measure the cost of debt, we consider interest. Okay, we consider interest over the total debt. So I believe you all know that from the revenue, when the company will deduct their total cost, okay, so what they'll get is the operating profit. What they'll get is called operating profit. Operating profit is also called as EBITDA, earning before interest, tax, depreciation, and amortization. From this, you subtract your non-cash expense like depreciation and amortization. So you'll get is EBIT, earning before interest and tax. From this, we'll subtract first interest. From this, we'll subtract first interest. So we'll get earning before tax, and then we'll pay tax. Okay, then it is called earning after tax or profit after tax. So since interest is deducted before the calculation of actual tax, so that way interest gives you something called tax shielding advantage. This advantage is called tax shielding advantage, what you will get from raising fund by debt. So that's why we deduct 1 minus T. We'll deduct the tax component from here to calculate the overall cost of capital. Okay, everyone. I hope this much everyone has understood. Okay, so the cost of capital, the other name is also called as cutoff rate or hurdle rate or minimum rate of return. So what is the significance of cost of capital? Now, the first point is evolution of investment options. So the estimated benefit future cash flows from the available investment opportunities, a business or project are converted into the present value of benefit by discounting them with the relevant cost of capital. So guys, whenever we want to analyze the cost of capital, we need to understand that whenever we are planning for a new investment option, or we are planning to start a new venture for which we need a capital. We need to understand that how much would be the WACC. WACC basically talks about the cost what is required to get into the project in the term of percentage. But once we get this cutoff percentage or hurdle rate, we need to signify this value in the term of the future cash flows what we can get from the project. So in order to get the cash flow, what we basically do, the earning potential, the profit after tax, what we can expect year on year basis, that is added with the non-cash inflows, or that is added with the non-cash expenses like depreciation, amortization, and then the adjustment of net working capitals are done so that we can get the cash flow, the future cash flows what we can get during the useful life of the project. Since these are the future cash flows, so in order to find the present value of these future cash flows, what is required, that once you can figure out the future cash flows on year basis, once we can figure out the future cash flows, so imagine the future cash flow after year one is FCF1, after year two is FCF2. This is free cash flow free for the third year. Like this, if I can identify the future cash flow for year on year basis, okay, what I need to do, I need to discount these cash flows with their WACC rate. I need to discount these cash flows with their WACC rate. And for that, what I'll do, I'll find their present value. So the future cash flow after year one, what is the present value for that? So this would be the present value. Future cash flow for year two, what would be the present value for this? So this would be the present value. Like this, you'll do for all the years. Okay, so then we can calculate the NPV of the project. So this is nothing but free cash flow for every year that you'll discount with their WACC, free cash flow for all the year that you'll discount with their WACC. Okay, so and then you'll get the sum total of of all free cash flows, the present value of these free cash flow. Okay, this will give you the sum total of the present value of the future cash flows, and that way we can analyze like what is the present value of the expected benefit what we can get from the available investment option, and that we can compare with the initial cost what is required to do the business. That we'll compare with the initial investment what you required to do the business, and if this turns to be positive, then working on this project makes sense. Okay, so next thing that once the investment options are analyzed, then the financial manager has to choose one of the two source of finance. Either uh, the fund can be raised by equity or the fund can be raised by debt, because whichever way the fund is raised, they have their own concern. Okay, if you are raising fund by debt, then debt brings a financial risk that tomorrow you get the profit or either you get the loss, you have to pay the interest. So that risk, the debt will come. In the case of equity, you don't have that risk, but in the case of equity, you're giving others the part of your ownership, and then them whom you have given the part of your ownership, they might disturb or they might affect your nature of doing business or the your ability to take risk, because we have studied in the first chapter called agency problem, the tussle or the conflict what happens between the shareholder and the management of the company. Because for the shareholder, maximization of shareholder wealth is very important, but management might take some decisions considering the short-term benefits, which might affect the worth of the company in the long run. So if we are giving the equity, if we are raising fund by equity, then we are giving others the part of our organization. We are giving ownership rights. Okay, whenever we are diluting our ownership in the form of shares, share gives ownership right or voting rights. So then those voting rights or those ownership patterns might affect your investment or your decision making abilities. Okay, too many owners will leads to confusion. Okay, then once an investment advisor or once an investment analyst or once the researcher of the company figure out the project on which they can put money, and then if they can calculate or work out the future benefits what they can get from the project, and then if they can analyze how they can raise this money, then what matters is to design the appropriate percentage of how the fund can be raised, in what proportion the fund can be raised by equity or debt, and then designing the optimum credit policy while appraising the credit period to be allowed to the customer. The cost of allowing credit periods is compared against the benefit earned by providing credit to the customers of the segment of the customers. That is very important. So we'll discuss about working capital management in the further chapters, where we'll work on the credit policies, or we can work on account payable or account receivable policies, which normally the management of the company plans once they come up with the final product in the market which they'll sell in the market, because ultimately the business works on credit, not on cash to cash. So once these consideration is done, then determining the cost of capital is again very important parameter, and we'll discuss about a determination of cost of capital in next session. So I don't want to increase the length of one class, so I'm ending the session here now, and we'll discuss the determination of cost of capital in next session. Thank you, everyone.